Welcome to Arabella Capital, where we're going to do our best to dive deep into real estate investing, how to invest in real estate, where and when, most importantly, to invest in real estate. So come join us, come learn with us, share comments, share experiences, and let's take this journey together. All right, I'm excited to have this conversation right now. I want to talk a little bit about my background and kind of how I got here, and ultimately started in the real estate industry with nothing as a young man in his early 20s, really not knowing what I was doing, to someone today who's worth around $40 million and growing very rapidly. I was born in a family of real estate investors and developers. I'm third generation, so I grew up around a lot of successful investors and family members. My grandparents built apartments, my cousins and all of them built homes and subdivisions. And so I did have a lot of exposure. On one side of my family had a lot of real estate investors, and they were all successful at what they did. And I did, my parents didn't do those things. So I grew up broke, basically, with a single mom raising 4 kids. It was very difficult and very challenging. And today I've been, this is my 21st year in business on my own, doing my own thing, and worth, tens of millions of dollars. And our business is very successful. It's growing very rapidly, but it was very difficult getting there. I thought that the way to get there when I was in my 20s was to read all these motivational books or self-help books, motivational speakers, be around other successful people and do all these things. And why, yes, those things do help. And that's not what worked, really. Those things did help with my mindset and my focus, and it helped with motivation and things like that. But ultimately, it didn't make all the difference. I thought I could just do that and work hard, and then I would make it and get there. And reality is I learned that no one gets anywhere on their own. We just don't. Think about all the times that you've been helped and guided along the ways. We just don't get anywhere on our own. We all have a specific role to play in this job. And my company today is I have a role to play. And everyone else on my team, they have roles to play as well. And they're all very important roles. So if you want to be a great real estate investor, you don't have to be a real estate agent. You don't have to be an architect or any kind of real estate professional or property management or anything like that. You just have to be able to operate a budget, be able to pay yourself first and save money so you can invest that money. You work, you make money, you follow those things, and you take some money, you save it, and you invest it. The easiest place for someone young to get started, a young individual or a young couple, if you have a job and you've got a little bit of savings, go buy a house. Buy a modest home. You don't have to put a whole lot down. It's your primary residence. Live in that house a couple years, build up some equity, and then you can take out a home equity line, go buy another house. Live in that house a couple years, rent it out, go buy another modest home. Nothing extravagant, because you have to be able to rent the house out when you're done with it. And do that 3 or 4 times. 3, 4, or 5 times. Now you've got a portfolio, and that basically is your retirement. You're done. All you have to do is manage it properly. Now, you could have saved up more money and used it as a down payment, or taken a home equity line out, used it as a down payment. But honestly, that's the easiest place to get started in real estate investing. Passive investing online into different real estate funds is great as well. But the main thing is you have to be able to save in order to invest. So really kind of focus on that. Set goals, manage your time, set priorities, get rid of all the pride. Stop trying to be rich. Stop trying to make a bunch of money. Money really, after having it now, it doesn't, they said it doesn't really buy you any happiness at all. But if you do the right things, your net worth's going to grow anyway. Now, let's talk about real estate professionals. Let's say you want this to be your full-time job. So now you have to know something. You're not just investing in real estate on the side. And I'll be honest, really, you can be a teacher, or you can be any kind of job that you have, and you can manage probably 10, 20, up to maybe 30 rental properties on the side of a job that you're having, and not have to worry about that. It's been done many times. I know a lot of people that do that. But if you want to go full-time, I guess like I did, and I just kind of jumped the gun, I would not recommend doing it the way I did it. I'm telling you how to do it. And I'll tell you some of the things I would recommend that work, and setting the proper goals, having faith, and being patient are key principles among those. You can go full-time in real estate by building your portfolio up and not having to get investors. But if you're trying to do it quickly, as long as you have the proof of concept, you got to be careful investing other people's money. When you're investing other people's money, you have got to learn the art, and this is an art and a discipline, of treating other people's money as if it's your money. And you just can't think your way through this. You've got to have ownership as if it's yours. And so you've got to have some, to make that easier, you got to have some skin in the game. You put some money in too. And you put all the work and you really focus on it. You're going to have some wins and you're going to have some losses, and you got to communicate those clearly. But once you start having some wins and you have other investors investing with you, and then it's a matter of you understanding the market well enough, understanding what should we invest in today. Like I said, we did build-to-rent communities. After that, I decided, single family, even new construction single family was not, was going to wane at some point. So started looking at vacation rentals. So in 2019, I decided, okay, we need to add vacation rentals to this portfolio. I think at the time we also had value-add multifamily. I didn't want to do any ground-up multifamily because it was too risky. I would only do value-add. I would do ground-up single-family rental properties, and we would do climate control self-storage. That's what I felt like, okay, we can mitigate risk. These are great products, and we'll be in a good spot. And 2020 hit. The market changed. Existing real estate became very expensive, so we had to scrap the value-add multifamily product because we couldn't buy anything to value add. It was too expensive. So we could only build from ground up at that point, and that's when I decided to pivot and focus more on vacation rentals. I'd already been researching those the prior year. So now we've got vacation rentals, we've got self-storage, and we've got build-to-rent, which build-to-rent was just taking off in 2020. And it was just doing really well, and technically so did the vacation rentals. I learned a funny thing, though, about the short-term or vacation rentals is I didn't have to build those ground up because I could find existing homes that just needed a little bit of work that were just cash flow ready to go, because people at that price point, if you're buying $1 million home, they already have money. They don't want to buy a fixer-upper. So there's a lot of existing product on the market, and this is not an institutional type asset class. And so, and I'm going into this detail because I want you to understand my mindset. It takes time to figure out what to do. You don't have to always know the answers, but you have to know if you put in some time and research, the answer will gradually come. So we did great. 2020 exploded. So in 2021, I had a decision to make. This whole time I've been trying to fund our portfolio, but capital was a lot easier to raise. So the idea was, let's double the size of our portfolio and just raise more capital while it's easy to raise. And so that's what we did. And so we grew really fast, really quick. And at the toward the latter half of 2022, inflation was going crazy. So the Federal Reserve decided to increase interest rates really fast, really quickly, and to kind of shut off the capital flow to the market, which they did. And here we are in 2023, and that made build-to-rent a very difficult product. Luckily, I had anticipated that at some point in time, this high in the market's going to come down. And if it comes down, what kind of position do we want to be in? So we want to be in a cash position. So at the beginning of 2022, we started putting a fund together. And I didn't think I thought I would need it sometime in 2023. I didn't think it was going to happen so quickly. But it was fine. We were ready to go. We launched the fund at the end of 2022, and I put my entire real estate portfolio in it and decided, okay, I'm going to take all this equity and share it with investors, and we'll recapitalize and have a really strong cash position going into our next recession, which means great buying opportunities. And that's what we did. And the idea was, okay, I don't want to just create a fund. And honestly, I talk about it like we did it real quickly. It actually took months and months and really over a year of research to figure out what kind of fund we wanted to do and how to structure it. I wanted the growth that came from developing, but I also wanted the income now that comes from cash flowing properties. But it's difficult to do both. And so I decided, okay, we're a developer. We'll just take all of our development fees and we'll put them in the fund as cash flow. Every time we start a new project, we make development fees from day one. And that becomes cash flow. So my pro forma went from 0 cash flow in year 1 to 12 or 13% return of cash flow in year 1. So it was amazing. So we had a strategy that now is working. We've got growth and we've got income from day 1. So I was like, okay, I'm putting all of my money into this because this is a great vehicle. It's a great investment vehicle. And that's what we did. We launched it at the end of 2022, end of last year. Coming into 2023, as the market started opening back up, I found out, okay, build to rent is not the belle of the ball anymore. It's not necessarily even the best opportunity. It's a great opportunity because demand is so high, and we're just scratching the surface with this new asset class. It's got a long runway to go. So, but the dynamic's different. So we tightened up our buy box, got a real solid, disciplined buy box, put it on autopilot. If we find a deal that fits our buy box, great, we'll buy it or build it. And if we don't, we're not going to do it. And then we kind of had to pivot again. I needed to pivot to assets that had a higher cap rate or a higher yield on cost because interest rates were higher. And the cap rate or yield on cost has to be higher than your interest rate that you're paying today to get positive leverage. So I did that. So I said, okay, we got storage. Yield on cost on storage was higher than today's cap rates, than today's interest rates. I think the yield on costs are like 7 or 8% for a storage project, which was great. And then we also had vacation rentals, which the cap rate on vacation rentals were 8, 9, 10%, also higher than today's interest rates. So there we go, positive leverage on 2 products. And we have already a portfolio of assets we bought. They already have equity in them. We put a lot of sweat equity in all the work that we did, created a lot of value in our portfolio, sharing that with investors. It also creates a buffer for any kind of down markets. And now here we are in a good position, a cash position to take advantage of the volatility in the market, to take advantage of a potential recession. And the reason I go in such great detail is because I want to illustrate is you're only going to get the next 2 or 3 steps, always. In any puzzle you're trying to solve, any goal you're trying to obtain, you can reverse engineer it as much as you want, but the reality is you're only going to get the next 2 or 3 real steps. If you try to reverse engineer the next 10 steps and you think you're going to take all 10 of those like that, and you're just going to force it, it's just not going to work. But if you can be a little bit more fluid and say, look, I think this is the way it's going to go, but let me take the next couple steps, and then we'll look again. Then we put our head down, take the next couple steps, and we look again. And mitigating risks, getting rid of the pride, just being humble, and treating people right around you, working hard, trying your best to do the right thing. All of those things are fun, and they ultimately lead to success. There's a bit of discipline that goes around it. There's a lot of discipline that goes around it as well. But you don't have to be doing it perfectly, but you have to keep getting on that horse, and you have to keep trying again. So I want to share this with our investors, and most importantly, I want to share this with my kids. So in discussing all this, if I haven't bored you enough talking about my background, everything I've done, if you'd like to know more about what we do at Arabella Capital and how our Arabella Real Estate Fund works, if you're interested in it, go to arabellacapital.com. The link will be right here in the video somewhere. I'm not going to point where because I don't want to be one of those guys that's pointing one place and somebody put the link somewhere else. But click on subscribe to our channel, like the video, and come take a look at our website and see what we're doing.